forget about the price. The price is distorted, period. It's distorted because on the LBMA, they can have a float of 260 million ounces, but trade 2.9 billion ounces per day. And I think you could argue if you have gold, this is the time to trade it to silver. You don't get opportunities like this very often. 150 years is the chart that I looked at, and it had only touched 100 twice, once almost, but twice or three times in the last 150 years.
Wow.
And every time it's anywhere near 100 to 1, the ratio falls back quickly. I mean, it just always has. And yes, you're right. It does have that historical catch-up pattern.
Be prepared for it to happen this year. Have enough gold and silver wherever you need it to survive the immediate aftermath of a dollar collapse. It could happen any time. It could definitely happen this year. I focus on the monetary philosophical aspect of these markets. I mean, I understand investment demand, I understand industrial demand, but monetary demand is a completely different thing, which we haven't seen yet. I bifurcate between investment demand and monetary demand because investment demand is what silver stackers do. It's like we stack silver. Why? Because we know that something big is going to happen. And whether we realize it or not, what that big thing is that an explosion of actual monetary demand. And what is monetary demand versus investment demand?
The picture I'm getting from our conversation, Andy, is that the establishment, if you like, and I don't mean the sort of the swaps, but, the big boys, the JP Morgans, the HSBCs and Goldmans and so on, have basically protected themselves. They know it's going up. And we get confirmation of this because the analysts say it's going up. They're putting in targets of, I think Bank of America said something like $3,500 this year. This is the sort of thing analysts say, but I think they wouldn't be saying this unless, there was a sort of internal confidence, if you like, that this doesn't do any damage to the book. I'm not saying that the Chinese wall has failed. I think that would be going too far. But the fact that they are talking like that, and there's some...
Good evening, investors and market watchers. I'm bringing you an urgent and revealing economic briefing that no serious precious metals investor can afford to miss. Tonight, we bring together the insights of three of the most respected voices in gold and silver analysis: Andy Schectman, Rafi Farber, and Alasdair Macleod, each offering critical intelligence that points to an imminent and dramatic shift in the precious metals market. Whether you hold gold, silver, or are watching, from the sidelines, what you'll hear today may reshape your outlook for 2025 and beyond.
Where it continuously lags behind gold as gold makes its bull move, but then typically will dramatically catch up and outperform gold on a percentage basis. Anytime you get near 80 to 1, Ivan, it's a sell signal for gold and a buy signal for silver or an exchange. You go back 5,000 years, and the ratio geologically was 16 to 1 for almost all of humanity. And now it's 7 to 1. As Keith Neumeyer will tell you, it's depleting in nature. Right. It's found in like your skin is epidermis. It's found in nature in a form called epithermal, right near the surface. Big deposits have been exploited years ago. And so if you have a 16 to 1 geologic ratio for most of human history, that has now fallen to 7 to 1 because it is the easy stuff has been scooped up. The price average has been 40-ish to 1 for the last 200 years, largely because of gold's role as money and silver in an industrial capacity. That's man's ratio. God's ratio said 16 to 1, falling to 7 to 1. Man's ratio for the last 200 years has averaged about 42 to 1.
Right.
And now it's 100 plus to 1. This is an opportunity you do not see but one or two times in an investing career. Look, I'm taking my gold salesman glasses off, and man to man, I would tell you that it's the opportunity of a generation. It truly is. And when you see the amount of concentrated short positions that seem to be unwinding in both London and in COMEX, the United States, because being naked short, when there's this kind of global demand coming out of China, who's flying all around the world buying up doré and concentrate, in particular Peru and Latin America, paying double what the West will, sending it back to China for refining as the second largest producer of silver in the world, and right. India buying north of 850, 900 million ounces over the last 4 or 5 years, and Russia adding it to their strategic stockpile. I don't ever remember a country doing that. And massive deliveries coming into the US, and the LBMA going from T+1 settlement to T+8 weeks because there's a shortage of trucks.
Wow.
Shit's breaking everywhere, and
Right.
things are happening everywhere, Ivan. And these distortions that you see only magnify the final outcome. But anytime in history you go back, you're anywhere near 80 to 1, let alone 100 to 1, you're near that reversal, that catch up that you speak of. And I would say there are very few times in history, in my lifetime or in anyone investing lifetime, where you can buy something that is that severely depressed based upon historical averages going all the way back, whether it be ratios between gold and silver or just, logic would dictate selling at these prices compared to where it was in 1980. I can't think of too many things that you can buy at a 40% discount to its 1980 price that has expanded massively in its uses.
Let's begin with Andy Schectman, CEO of Miles Franklin Precious Metals. Schectman delivers a stark warning. The price of silver is not what it seems. According to Schectman, today's market pricing is heavily distorted by paper trading mechanisms. On platforms like the LBMA and COMEX, where daily silver trade volumes can exceed 3 times the world's annual mine supply, he emphasizes that the gold-to-silver ratio, a key historical metric, has climbed to over 100.1, a level only touched a handful of times in the past 150 years. And every time it has, a swift and powerful reversion has followed.
Investment demand is when you stack silver in anticipation of monetary demand, because you expect the monetary system to break down. And monetary demand is different from industrial demand because everyone demands money. Everyone needs money for something. Otherwise, there is no division of labor. So that's a much more fundamental thing. When we look at the futures markets of silver price, whether it's on the LBMA or the COMEX or whatever the contract is, what's the price of what we're looking at? We're looking at the price of industrial demand and some investment demand, but we're not looking at the price of monetary demand, because monetary demand is when everybody wants it to exchange against other goods. And when that happens, that's when gold to silver falls to like 15 to 1, as it does in every monetary panic in history. That's what always happens. Why? Because most people can't afford gold, so they go to silver, which is already starting to happen, but it has a lot more to fall. It fell to 15 to 1 in 1918. It fell to 15 to 1 in 1980. It's going to fall to 15 to 1 again, and that's when we are in a full-blown monetary crisis. What I keep saying, everyone sees prices going up everywhere in the world. It's not a goods problem, it's a money problem. It's a money problem because we see basic necessities going up faster than any other prices. So everyone's focused on, the broad inflation numbers. They don't matter. They do not matter, because in any hyperinflationary economy, you have basic necessities going up really, really fast, and luxury items either not going up at all or going up much slower than basic necessities. So in this kind of environment, we're seeing like the developings of a financial crisis already coming into fruition. We're seeing like, what is it? The tide comes in and you realize who's naked. So the tide's starting to come in and the people on the edges are, they're already naked, whether it's the UK pension plans or FTX, some kind of crypto exchange. I mean, these things are going to start happening week in, week out now, and faster and faster. And eventually the central banks are going to have to reverse. And when they reverse in the environment of inflation, whether it's 8%, 7%, 6%, 5%, they're going to reverse. And then everyone's going to attack the precious metals, because that's what humans do. That's what's going to happen. Exactly when the central banks break and start printing again, I don't know. But they're going to, because there's going to be humongous pressure to do so. So when that happens, I think silver gets drained from all the centralized stockpiles, COMEX, LBMA, whatever silver fund happens to be holding silver unallocated in the Perth Mint or Switzerland or whatever. It's all the same stuff. It's just different piles. They're all going to be attacked at the same time. And you can use any of them as a proxy for any of the other ones. So it's the same game over and over again. When they run out, and we win because we're stacking and we're not selling. Well, we saw it once in July of 2020 when I think the number of deliveries was higher than the amount of registered silver available. And so I think JP Morgan rushed, it was 45 million ounces from its eligible pile into the registered. I don't know exactly why they did that, because I think deliveries going into the COMEX not out at that time, but it was at least on net. So it was confusing what was happening, but at least we see the mechanism of what would happen if registered supplies go to zero. You'd see some bank or other with a whole bunch of eligible supplies put them into registered category, because it's happened before. But again, the rule changes in the COMEX in 1980, they did them because they could. The situation there was we were already basically back on a gold and silver standard in 1980, at least in terms of the Fed's balance sheet, because the valuation of gold at the time was enough to back all of the Fed's liabilities on its balance sheet by over 100%. That is the definition of a gold standard. And the gold-silver ratio is about 15-1, which is the general gold-silver standard that we've had for hundreds of years before that. So
Farber warns that a global monetary crisis, fueled by the accelerating devaluation of fiat currencies, may trigger this shift sooner than many expect. As inflation erodes public confidence, necessities are becoming more expensive while luxury items lag, a classic early signal of hyperinflation. When the monetary panic arrives, Farber predicts silver will surge in demand as an accessible store of value for the masses, driving the gold-to-silver ratio back toward 15-1, a level historically seen only during full-blown currency collapses, such as in 1918 and 1980. He urges investors not just to hold silver for profit, but to prepare for a time when it may be required for everyday transactions. Farber foresees a breakdown of centralized silver exchanges and a return to physical trading, a decentralized market where coins and bullion could once again function as real money. Now to Alasdair Macleod, renowned economist and precious metals strategist.
Story out of Goldman Sachs that, if this happens and that happens, it could be $4,500 sort of thing, So they're definitely going in that direction. And they read the charts. You and I read the charts. We can see this, and we can see that, okay, things don't go up in a straight line, but the direction is quite clear. So these guys are not fools. They're not fools. And nor are the swaps. The swaps actually see the position and, okay, they trade it and they make lots of money trading it. But the problem is that their mark-to-market values are deteriorating the whole time. They want to control that. But the people who haven't bought this are everybody else. I mean, the extraordinary thing is, less so with silver, but if you look at open interest on COMEX, gold COMEX, I mean, we're now, on preliminary figures, we're just under 500,000 contracts. This is not an overbought market at all. And if you look at the ETFs, as some sort of indicator of public interest, it's just beginning. It's only just beginning. And you and I know that from the psychology of the market, that when something breaks into new high ground, it's only then that perhaps that the wider public sit back and say, this is interesting. And in this case, it's even more interesting because the wider public just don't understand what the hell's going on. So, and not only that, but their compliance officers say, no. It's not a regulated investment, so you can't buy this. So they're forced into buying ETFs. I mean, and the whole of the mining sector has been ignored, and the big brokers have more or less shut down their commodity and mining side. So, when it comes to the portfolio shifts, and here we are, end quarter one, when this is actually being recorded, and this is what, the 2nd of April, end of quarter one, an investment manager sitting there, he's sort of thinking, I got to write a report. What have I got to say? And you can see that the tech stocks are tanking. Bitcoin, if he's stupid enough to have some of that, is tanking. And ordinary, financials are tanking. Other industrials ain't doing too well. In other words, all the sort of momentum stocks are really coming apart. And if you look at the best performing asset of the lot, it's gold and silver, and I haven't got any. So this is early days, very early doors for this, for this change. Quarter one is terribly important because, this coming week, or coming 2 weeks, there will be committee meetings to try and get investment strategy going. And, they'll be looking at this. Come on, why have you missed this? I don't know what's happening. I mean, I'm lost. Help. You can see the problems. But unless they actually load up on gold and gold substitutes and silver substitutes, their performance, just look at the charts, is going to be very, very badly compromised. And, investment managers don't necessarily want to make money for their clients. I mean, what they've got to do, basically, is...
Perhaps most critically, Macleod unveils China's long-term strategy. For years, China has been absorbing global silver supplies, refining vast quantities domestically, and keeping that metal off the open market. In 2023 alone, Chinese net silver, Imports nearly equaled the global supply shortfall reported by the Silver Institute. This deliberate stockpiling, combined with price suppression tactics involving Western banks, has allowed China to accumulate massive reserves at artificially low prices. At the same time, BRICS nations and Gulf states are reducing their exposure to U.S. debt and moving toward a post-dollar trade system. As foreign ownership of U.S. treasuries declines and fiat currencies falter, Macleod foresees a monumental rotation into real assets, led by gold and silver. He also points out a crucial, overlooked opportunity: the mining sector. Globally, the total market capitalization of gold and silver miners is minuscule compared to tech giants like Microsoft. As precious metals prices rise, even modest reallocations of institutional capital into mining stocks could drive explosive gains. Historically, miners have outperformed the underlying metals by factors of 3 to 10, especially during major bull markets. So, what does all of this mean for investors? Schectman argues, this is a once-in-a-generation opportunity. Sovereign nations like China, India, and Russia are rapidly acquiring physical silver, even as Western investors remain largely unaware. Notably, China has been purchasing silver concentrates at double the prices offered by Western buyers, quietly building its reserves. Schectman warns that despite the market's appearance of stability, a severe supply crunch is developing beneath the surface, intensified by military and industrial demand, and by the growing interest of sovereign wealth funds standing for physical delivery. His message to investors is clear. Silver is not a speculative bet. It is wealth insurance in a financial system facing systemic breakdown. And for those already holding gold, Schectman suggests now may be the perfect moment to consider trading some of that gold into silver, capitalizing on the extreme ratio and the coming price convergence. Turning to Rafi Farber, financial analyst and respected monetary theorist. Farber shifts the focus from pricing mechanics to the deeper monetary forces at play. He differentiates between investment demand, the typical behavior of silver stackers, and monetary demand, which occurs when the public at large turns to precious metals not as investments but as currency. Macleod brings a global perspective, exposing the behind-the-scenes maneuvers of the financial elite. According to Macleod, major Western financial institutions, J.P. Morgan, Goldman Sachs, HSBC, have already repositioned themselves. They're no longer betting against gold and silver. Instead, they're quietly preparing for a historic repricing. He cites Bank of America's forecast of gold reaching $3,500 an ounce, with Goldman Sachs floating even higher numbers. But here's the key. Public participation in this market remains minimal. Open interest on COMEX gold contracts is far below levels seen during past bull runs, and holdings in ETFs like GLD and SLV remain relatively low. Institutional players see what's coming, but the average investor has yet to wake up. First, the smart money, sovereign funds, institutional traders, and nation-states has already begun shifting into precious metals and out of fiat risk assets. Second, the retail crowd has barely noticed. When the inevitable monetary pivot occurs, when central banks resume printing in response to the next crisis, demand for gold and silver will surge, draining remaining physical supplies and driving prices far beyond current projections. And third, the window for quietly positioning before this tidal wave hits is closing. Schectman, Farber, and Macleod may differ in their specific forecasts, but they agree on the fundamental trajectory. The era of suppressed precious metals is ending. Systemic realignment is underway, and those who prepare now will stand to preserve and potentially multiply their wealth as the financial landscape transforms.